Hey everyone, and welcome back to the channel. If you're thinking about investing your hard-earned money in 2025, you've probably hit a major crossroad. Should you buy individual stocks, or should you go for ETFs? It's a classic debate, like choosing between pizza and tacos. Both are great, but they serve different appetites. Today, we're going to break it all down, plain and simple, so you can make the best choice for your financial future. So let's start with the basics. What exactly are stocks and ETFs? Imagine a company, say a popular coffee chain. When you buy a stock, you're buying a tiny piece of that single company. You become a part owner. If that coffee chain does incredibly well, opens new stores, and sells a ton of coffee, the value of your stock, your little piece of the company, can go up. You share in its success. But if they make a bad business decision or a competitor steals their customers, the value of your stock can go down. It's a direct bet on one company's performance. Now, think about an ETF, which stands for Exchange Traded Fund. Instead of buying a piece of just one company, an ETF is like buying a whole basket filled with stocks from many different companies. For example, you could buy an ETF that tracks the S&P 500. By purchasing just one share of this ETF, you're instantly invested in 500 of the largest companies in the US and tech giants, healthcare leaders, major banks, you name it. It's like buying a pre-made investment portfolio in a single transaction. This brings us to the first huge difference: diversification. With stocks, you have to build your own diversification. If you only own stock in that one coffee company and it goes under, you could lose your entire investment. To be safe, you'd need to research and buy stocks in maybe 15, 20, or even more different companies across various industries. That takes a lot of time, a lot of research, and a lot of money to buy all those individual shares. ETFs, on the other hand, have diversification built right in. That S&P 500 ETF we mentioned, if one or two of those 500 companies have a bad year, it doesn't sink your whole investment. The other 498 companies can help balance it out. This instant diversification is probably the biggest reason why ETFs have become so popular, especially for beginners. It helps to manage risk without you having to become a full-time stock market analyst. It's a classic case of not putting all your eggs in one basket. Next up, let's talk about control and potential returns. This is where stocks really shine for some people. When you pick individual stocks, you have complete control. You are the captain of your ship. If you have a strong belief that a specific company, maybe in renewable energy or artificial intelligence, is poised for explosive growth, you can invest heavily in it. If you're right, your returns could be massive, way higher than the overall market average. Think about the people who invested in companies like Amazon or Tesla early on. They saw life-changing gains because they picked a winner. With an ETF, you're essentially aiming to match the market's performance, not beat it. An ETF that tracks the S&P 500 will give you returns that are very close to the average return of those 500 companies. You'll rarely have a huge, explosive gain from an ETF in a short period, but you're also much less likely to suffer a catastrophic loss. It's a smoother, more predictable ride. So you have to ask yourself, are you looking for that potential home run, knowing it comes with the risk of striking out? Or are you happy with consistent singles and doubles that steadily build wealth over time? Let's also consider the cost and ease of management. Buying and selling individual stocks can get expensive if you're making a lot of trades. Though many brokers now offer commission-free trading, the real cost of stocks is the time and effort. You need to constantly research your companies, read financial reports, and stay on top of industry news. It's a hands-on approach. Are they launching a new product? Did their CEO just leave? All these things can affect your investment. ETFs are the champions of set-it-and-forget-it investing. They are incredibly low maintenance. Because they automatically track an index, you don't need to worry about the day-to-day news of every single company in the fund. ETFs also have very low fees, known as expense ratios. We're talking fractions of a percent per year. This low cost and ease of use make them an amazing tool for passive investors who want to build wealth without making it a part-time job. So, where should you invest in 2025? The truth is, there's no single right answer. It completely depends on you, your goals, your risk tolerance, and how much time you want to dedicate to managing your money. If you're a beginner, or if you prefer a low-stress, hands-off approach, ETFs are probably the way to go. They offer instant diversification, low costs, and a simple way to get started in the market. They are a fantastic foundation for any investment portfolio. You get broad market exposure and can sleep well at night knowing your risk is spread out. If you're someone who loves research, enjoys analyzing companies, and is willing to take on more risk for the chance of higher rewards, then picking individual stocks might be for you. You get to be in the driver's seat and have the potential to significantly outperform the market. But remember, with great potential returns comes greater risk. It requires homework and a strong stomach for market volatility. But here's a thought. Why not both? This is what many savvy investors do. It's called a core and satellite strategy. Your core can be made up of broad market ETFs, providing a stable, diversified foundation for your portfolio. This is your safety net. Then, your satellites can be a smaller portion of your portfolio dedicated to individual stocks you believe in. This allows you to have that stable base while also taking a few calculated shots at those high-growth opportunities. It gives you the best of both worlds. Looking ahead to 2025, the market will have its usual ups and downs. Whether you choose stocks, ETFs, or a combination, the most important thing is to have a plan and stick with it. Don't panic sell during downturns, and don't get greedy during upswings. Consistent, long-term investing is the proven path to building wealth, regardless of the vehicle you choose. So, which path are you leaning towards for 2025? Let me know in the comments below. I'd love to hear your thoughts and strategies. Thanks so much for watching today. If you found this video helpful, please give it a big thumbs up, and don't forget to hit that subscribe button and ring the bell so you won't miss our next video. We've got a lot more financial wisdom coming your way. Until next time, invest smart and stay curious.